Hello, very good morning to all and welcome back. I hope that you all have a great, wonderful and restful long weekend. I'm Kelvin here again. Very good morning. Welcome to today's Daily Dose of Market Insight. Today will be the Tuesday, the 18th of June 2024. So before we jump straight into our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term intraday technical outlook on the various key cross assets, let's have a recap of what has taken shape on last Friday and yesterday in terms of economic data releases, news flow, and as well as how this news flow and economic data releases impact the performance of the cross assets. So let us start with the key economic data releases on last Friday. So on last Friday, we do have a release of one of a key economic data. I would say it's much more of a leading economic data. Why? Because it involves consumer sentiment, because consumer sentiments tends to lead consumer spending. So this is the US University of Michigan Consumer Sentiment data. That's for the preliminary data for the month of June. So we know that the University of Michigan, they releases the data twice. So middle of the month, they release the preliminary one, and coming towards the end of the month, they release the finalized data for that said month. So let's take a look at this data releases, the findings of these data releases. All right, so let me zoom to my screen. Yeah, so on my screen over here, you could see at the top of my screen, this is the data release for the University of Michigan. All right, consumer sentiment for the month of June. So it came in at below expectation of 65.6. And do you notice that there's this slide over here? And this slide of 65.6 is the lowest so far since, this level is the lowest so far since November last year. Okay, go back, right? All right, around this period in time. So what we could see over here is that it seems to us that consumer sentiment still remains lackluster, has started to turn lackluster, despite that push up that was seen in February and January this year, and it starts to plummet down towards. And what's interesting over here is that within this University of Michigan report, there's actually two subcomponents where the University of Michigan, we call it the compiler. This is the compiler. They actually surveyed the respondents' inflationary expectation 1 year from today and 5 years from today. This depending on the month of June where they actually started the survey. So if you look at it over here, the 1 year inflation expectation, that means going for 1 year ahead, has started to actually tick upwards as well to 3.3% from the low of 2.9% in March. All right, there's a rebound over here. And what's interesting over here is that longer term inflationary expectation has also starts to tick up as well from April reading of 3%, it actually went up to 3.1%. So it seems to us that inflationary expectation is not coming down based on the survey base of University of Michigan poll. Instead, it remains rather anchored at around 3.3% for the 1 year. And for the 5 year inflation expectation, it remained anchored at around 3.1%. So that actually goes against the US Federal Reserve goal of hitting inflation at 2%. All right, so it doesn't seem to be inching downwards towards that 2% growth. target. All right, and also what we could see over here is that the University of Michigan consumer sentiment has started to turn lackluster as well. So there's still kind of lingering odds, not really that high, but slightly lingering odds of this stagflationary risk environment. So going forward, this is one of the data that I'll be watching, given the fact that we start to see ongoing risk on behavior that is still persistent in the US stock market, driven by a very robust upgrade of earnings growth for Q2, especially centered around the mega cap stocks that is being driven by AI team play. All right, so yesterday, what we could see over here is that markets, the risk assets in US, that means i.e. we talk about the stock market, continue to ignore such not so rosy key economic data, but continue to push up higher, driven by earnings upgrade, all right, and as well as the momentum play that is being centered in on the mega cap stocks, especially on the AI driven component of it. So yesterday, the US S&P 500 and the Nasdaq 100 outperformed and managed to hit another round of fresh all-time high, 0.77% for the S&P 500, the Nasdaq 100, the top performer, 1.24%. The Dow Jones even rallied as well, 0.49%, and the Russell 2000 up 0.8%, despite the fact that the Dow Jones and the Russell actually had negative performance or losses on last Friday. So later we touch more about the short-term technical outlook on the Dow Jones Industrial Average. So another news flow that took shape yesterday was more or less driven by this ongoing geopolitical tension in the Eurozone, which is surrounding potentially right-wing European parties getting a foothold that could potentially drives up the budget deficit in Eurozone, which doesn't gel well for the European stock indices that continue that actually underperformed 2 weeks, which eventually also lead to this Euro currency sell-off, where we start to see the rise of dollar strength that is going against the traditional intermarket relationship. Okay, once we start to see very significant push up in dollar strength, we tend to see a major risk off globally. But at this point in time, it's only being centered on the Eurozone economy. All right. So what we could see over here yesterday, the French key right-wing politician came out and she did make a speech over here saying that which is Le Pen. So Le Pen, that even though Le Pen party managed to gain a foothold in the upcoming France localized legislative election. That's not the France presidential election, because France presidential election likely will be only, I believe, 2 years from now. So in fact, the upcoming one is the local France parliament election. So based on the current poll, there is very high chance that the right-wing party, the nationalistic party led by Le Pen, may gain a significant foothold. But yesterday she made a kind of a reassurance or a speech saying that she will not try to push out Macron if she wins the vote. All right. So for those who are actually paying a very close attention to this particular area of the financial markets, that means i.e. the European stock indices, just have a friendly a footnote, a reminder. These are already covered in last Friday daily dose of market insight. Is that the France election, there will be 2 rounds. This is the parliamentary election on the stress against, not the presidential election. It will be held on the end of this month, 30th of June, the first round, followed by the second round on the 7th of July. All right. So based on this ongoing right-wing party that's gaining a foothold, it causes the European currency to actually underperform. So what we could see over here is this. All right. So this is the 3-month rolling performance of my chart based on, as we are speaking right now. So all these index are actually based on OANDA CFD prices, Nasdaq, S&P, that are leading the fort. Even we start to see a push down in the France, which is the CAC, the cut benchmark indices, which is the underperforming index right now, is actually dragging down the FTSE as well. So we could see that FTSE as a peak of 15th of May is actually coming down as well. And even the German DAX has also starts to reduce its positive performance that was seen on 16th of May, and right now it managed to inch up slightly higher at 0.76%. So the worst hit was still the France CAC, is down -7% as we are speaking right now, based on their 3-month respective rolling performance as of today. So what we could see over here is that despite the fact that the France is the one that is dragging the German, and it doesn't also spell quite well for the UK FTSE as well. And what's interesting over here is that the drag on the France CAC, due to this geopolitical risk premium that is inherent inside the European Union, has managed to see a firmer dollar index since the middle of May 2023, and it actually started to be much more pronounced since the start of this month by shaping a series of higher low, and it starts to do a minor bullish breakout as well. Okay, over here, okay, you could see this green line that I drew. All right, so now let me remove this green line. Okay, so this is the story rising up from there. So given that yesterday's this particular so-called reassurance speech from the right-wing leader, the French party leader, Le Pen, that managed to actually saw the European stock indices shaping that minor counter trend rebound after that steep sell-off last week. So the European stock indices yesterday all closed in the green. The German DAX up 0.37%, the CAC CAT, the French CAT 40 up 0.91%, and the European Euro Stock 600 up almost unchanged, and the much more centric Eurozone Euro Stock 50 up 0.85%, and the FTSE 100 almost unchanged at negative 0.06%. All right, and one more particular news flow I'd like to share that took shape yesterday was centered more on the Chinese related news flow, which is the industrial production, retail sales, housing prices. So it's a rather a mixed slew of data. Why do I say that? Because the housing market continue to be in doldrums, because if you look at the index is okay, whoops, sorry, what is this? Okay, yeah. So you look at the housing price index for China in the month of May, it continued to plummet to negative 3.9% year on year, much more weaker than negative 3.1% that was printed in April. So if you look at the entire trend of this housing price index, it continues to be weak, and this is the 11th consecutive month of decline. All right, you could see it plummeted all the way down. And if you look at the 5-year trend, okay, maybe the 10-year trend. Okay, so this level that was released yesterday, at 3.9% year on year for May, is the weakest level, okay, since May 2015. All right, so what we could see is a very strong circular downtrend in the housing market for China. So as we know that the housing market for China is the key wealth effect that could influence China consumer spending and China business corporate fixed investment. That means company doing pumping up their fixed investment. That means not stocks, are fixed investment. That means i.e. pushing up their, we call it a capital investment to improve productivity gains. But if the housing market going to plummet, and the housing market, like I explained, being a key wealth effect component of the Chinese economy, that it could have a negative adverse impact on China retail spending, and as well as corporate spending in terms of capital infrastructure to boost productivity gains. So that could actually starts to see in the numbers. If I could explain to you all, the retail sales so far managed to actually improve instead. Why? Because of the slew of ongoing we call it initiative that is initiated by the China top policy makers to actually supplement this negative wealth effect from the housing market. So 2 months ago, the China actually encourage China consumers to actually exchange they are all, we call it a housing household appliance. So that actually also kind of boosts retail sales a bit for the month of May. So it's up 3.7% versus 2.3% year on year in April, and slightly above consensus of 3%. But the fixed investment asset investment that is much more related to corporate spending has been rather lackluster at 4% and came in slightly below expectation of 4.2%. So overall, it's much more of a mixed kind of scenario, not so neither good nor neither bad for the China side of the story. And with that, the China Central Bank continue to lift one of their key benchmark interest rate is the 1-year NFL rate. So this particular rate is actually based on the rate that is the China top commercial banks, the local commercial banks could borrow directly from the China Central Bank. So they maintain it at 2.5%. All right, so it seems to us that the Chinese top policymaker is still in a mood of issuing bit size or piecemeal size of fiscal stimulus to address if there's any ongoing further weakness coming out from the housing market. That means they are still in no rush to enact very strong QE policy. Okay, so overall, a rather mixed performance on the China stock market yesterday as well. All right, so with that kind of sum up the slew of key data releases on Friday and yesterday. Now, let me take you through the key intermarket dynamics right now. The first key intermarket dynamics I will share with you all, the key focus will be much more focusing on the US stock index. Why? Because a lot of people have been pretty much concerned the rally of the US stock market right now because it's approaching all-time high. Can it be sustainable, or will that be a big crash going forward? Because everybody wants the market going up all-time high, they'll be concerned about a crash about 20%, given that we know that the US Federal Reserve is not in tune of rushing to ignite the first interest rate cut. All right, based on last week release of the dot plots, which I share in the daily dose as well, so I don't touch more about that. So now let us look at some of the intermarket dynamics that is related to the US stock market. Okay, starting from this dynamic, like I share with you all, is looking at the factor-based ETF, the S&P factor-based ETF against the normal S&P 500. So the top chart over here is the S&P 500 continuing to inch higher high. All right, yes, price action is rather steep, but what we could see over here is that we got to respect this uptrend. Why? Because it's very clearly trading above the 50-day and the 200-day moving average, and it's being supported by ongoing momentum, positive momentum play. As okay, give me a minute, it's very slow, as depicted by this ratio chart where I plotted the S&P 500 momentum ETF divided by the normal S&P 500. So I'd like to repeat again for those who are first time seeing or hearing me mentioning about this momentum ETF, SPMO, the ticker code. So this is a S&P 500 same component stock. So what the ETF manager did is actually being run by Invesco. They actually re-rank the S&P 500 component stock according to a momentum factor. That means, i.e., the stocks that had the component stocks inside the S&P 500 that has a higher momentum reading will be given a higher weightage. All right, so this is what I mean by S&P momentum factor. So since the bullish breakout on 20th of February this year, the S&P momentum 500 momentum factor has been continuing to outperform against the normal S&P 500 index. So indicating to us that the rally has been pretty much supported by positive momentum play, okay, within the S&P 500. All right, so this particular move itself continues to actually support the ongoing risk-on behavior on the S&P 500 and also the Nasdaq 100. And yesterday's push-up has led to a fresh all-time high of this ratio chart, the S&P 500 momentum divided by the S&P 500. And one thing positive about this ongoing positive impact of positive momentum, breeding more positive momentum, has been spread on to the other factor-based ETF. All right, which is the quality ETF. Okay, so over here, what is this quality ETF? Okay, so it's basically same particular ETF that is being run by Invesco. So the ticker code is called SPHQ. So this particular S&P 500 quality ETF, there is no changes to the S&P 500 component stock. What Invesco did, which is the ETF manager, they re-ranked the S&P 500 according to the quality factor. So those S&P 500 component stock that has a higher quality factor is being assigned to a higher weightage versus the normal market cap weightage, which is just based on the market cap times by price. Okay, price and free float, the number of shares that's available for trading. So this S&P quality 500 ETF, I just divide it by the S&P 500, make it as a ratio chart, which is a relative performance chart. Previously, it has been underperforming, okay, since October 2023 last year, and it's going to inch up higher during the start of this year, but it's actually lagged behind the momentum, which has already staged a bullish breakout earlier on March this year. But due to the positive momentum play that is now spreading on to the other quality factor ETF, this quality factor ETF managed to stage a bullish break on last Friday, breaking above this prior major descending trendline resistance and managed to hit a fresh 52-week high. So what we could see over here is that the quality ETF right now, it has started to outperform the normal S&P 500, which is rather positive, I would say. That means positive momentum has now spread to positive quality based factor, which is actually supporting this ongoing risk on behavior. That means, i.e., what I'm trying to stress to you guys over here is that in terms of the ongoing rally that is being seen on the S&P 500 and the Nasdaq 100, is not bubbly like yet, because it's being supported by momentum factor and now spreading on to the quality factor. And now the next thing, intermarket dynamics I share with you all surrounding the US stock market is that market breadth on the S&P 500 and the Nasdaq 100 from a short-term to medium-term perspective has also improved as well. So if you were to share, let me share with you the next thing over here will be, I think it should be this one. No, it's not this. Not this chart. Okay, there's one particular chart I'll share with you all. Is it this chart? Okay, I think I accidentally closed the chart. Is this a chart? Yes, this is the chart. Okay, so this particular chart is the market breadth chart, where I actually able to obtain from TradingView is to plot the percentage component stock within the Nasdaq 100 and the S&P 100, how many of them are above their 20-day and 50-day moving average. So if you look at the Nasdaq 100, for sure is actually the top performer among the major US stock indices right now. But what we could see over here is that the percent of stock above that, the percentage of Nasdaq 100 component stock above the 20-day moving average has started to improve significantly since the start of this month, shaping higher low. And based on yesterday's closing price, 59% of them are trading above their 20-day moving average. All right. And what you could see over here, very similar for their 50-day moving average as well. So the percentage of Nasdaq 100 stocks above their respective 50-day moving average has also continued to drastically improve as well since the end of May. And yesterday, based on yesterday closing price, is at 59%. All right, so this is positive, and this positiveness has started to spread out to the S&P 500 as well, but not as great as compared to the Nasdaq 100, because the Nasdaq 100 has heavy weightage in Microsoft and especially Nvidia, okay, and the other, we call it semiconductor stocks that has higher weighting inside the S&P 500, that is not inside the Nasdaq 100, pardon me, that is more aligned or heavily concentrated on this AI optimism team play at this point in time. So the S&P 500 has a broader, we call it a sector play, not so much heavily concentrated on the semiconductor, because they do have consumer discretionary and as well as financials to actually take note of. So, but if you look at the percentage of S&P 500 stocks holding above the 20-day moving average has started to improve from the end of May as well, okay, shaping higher low, okay, higher low over here. So what I could see is that yesterday's closing price, it managed to see 40% increase. All right, 40%, okay, 40% on 40% of the S&P 500 component stocks are trading above their 20-day moving average, which is rather positive as well after we start to see a higher low, but hasn't been much as good as the Nasdaq 100. All right, so if we start to see a couple of days it's going to inch up higher, this is actually a good sign that short-term market breadth has started to improve on the S&P 500 as well. Okay, the next one will be the percentage of, sorry, a bit hard to click. Okay, the percentage of S&P stocks holding above their 50-day moving average. So what I could see over here is that it also starts to improve as well since end of May, shaping higher low, we could see. So based on yesterday's closing price, is much better than the percentage of stocks holding above the 20-day moving average. This one inch up to 45%. All right, for the S&P 500. So that net overall, what we could see over here is that going forward, right, this particular market set of market breadth component, market breadth indicators on the S&P 500 and the Nasdaq 100, their short-term market breadth continues to actually show improvement rather than deterioration, which is also support this ongoing short and medium-term uptrend phases that is being depicted on the S&P 500 and the Nasdaq 100. All right, so with that, that sum up the today's intermarket key dynamics analysis that I will share with you, primarily focusing on the S&P, okay, on the US stock market. All right, pardon me. So right now, let us now jump straight into the short-term technical outlook, starting with the US US dollar major pair first. All right, so before we jump into the major US dollar, the major US dollar pair, sorry, maybe a bit of tongue twisting. Let's have a quick look at the 5-day rolling performance of the dollar against the major currency. So no change, right? Since last Friday, we start to see sideways movement among the dollar major against the other currency. All right, still kind of a sideways rangy movement. So now with that, let us now jump straight to the euro dollar short-term intraday technical outlook that I'll share with you all first. Okay, so before I jump on the euro dollar chart, let me expand my screen so that you guys could see. So for those who follow our daily dose of market insights on a very frequent basis, those who recall that last week we do have a bearish bias on the euro dollar, and on last Friday it indeed hit the short-term support level at 1.069 followed by 1.056, which is a key medium-term pivotal support level. So what is 1.0656? Going to the daily chart, you guys could see much more clearer if I expand on the daily chart. Is actually the lower boundary of this potential symmetrical triangle range configuration that the euro dollar is being tracked since the high of 19th of July. And the lower limit of this symmetrical triangle is this ascending trend line support that I drew from 4th of October, and right now is coming very close to a support level at 1.0656, which was almost hit on last Friday before it shaped a series of higher low on yesterday's European session and managed to help firm throughout the US session yesterday. And given the fact that we start to see a bullish divergence as well on the hourly RSI, okay, there's a bullish divergence, price trading lower low but higher high or higher low on the hourly RSI. So with that, what we could see over here is there could be a chance of a counter trend rebound that could or that may take shape on the euro dollar, given the positive element that I just shared with you. So with that, we'll be flipping to a short-term intraday bullish bias, potentially for this minor counter trend rebound scenario that may unfold, with a key short-term pivotal support to maintain this scenario that may unfold, the minor counter trend rebound scenario may unfold at 1.069 level. So as long as this level holds, we'll be flipping to a short-term intraday bullish bias. First resistance level to watch will be at this red line here at 1.0745. A breakout of this level exposes the next resistance zone at 1.077, 1.0790, which is also confluence with the 50-day and the 200-day moving average, I think, as a resistance as well. However, an hourly close below 1.069 level will invalidate this potential minor counter trend rebound scenario on the euro dollar to see the continuation of euro dollar weakness to expose the medium term's key support area or support level at 1.0656. A breakdown below it exposes the next support level at 1.0620/1.06 level, which is the swing low area of 16th of April and 19th of April. All right, so that's for the euro dollar. Now, moving on, next will be the short-term intraday technical outlook on the sterling dollar. So the sterling dollar also plummeted on last Friday, hit the support level that we mentioned as well. So, and as well shaping that higher low that's being flashed out on the hourly RSI on Monday yesterday. So with this positive short-term technical element, there could be a chance as well for the sterling dollar to shape a minor counter trend rebound scenario after that steep sell-off that has taken shape on last Wednesday. So 2 days of steep sell-off. So with that, I'll be using 1.2645 as my short-term pivotal support level for today to potentially flip to a short-term intraday bullish bias for that potential minor counter trend rebound scenario to play out. Next resistance level to watch 1.2740, which is also confluence with the 20-day moving average. A breakout above it exposes the next near-term resistance at 1.28 figure level. However, an hourly close below 1.2645 will invalidate today's short-term intraday bullish bias to see the continuation of this softness in the sterling dollar to expose the next near-term support level at 1.2605, followed by 1.2565, which is the 200-day moving average. That's, I think, it's a support as well. Now, flipping to the Asia Pacific dollar pair, let us start with the Aussie dollar first. So for the Aussie dollar, also slide down towards the 50-day moving average and also close to the minor swing low of 10th of June that we highlighted on last Friday. So more or less, the support level has already been met. And interestingly, the hourly RSI also start to shape a bullish divergence as well. So with that, we'll be flipping to a short-term intraday bullish bias as well on the sterling dollar using 65.80 as my short-term pivotal support level for that potential minor counter trend rebound within its medium-term symmetrical triangle range scenario, that's configuration that's still playing out. But on the short-term intraday basis, key resistance to focus will be this two level, 66.30. A breakout above it exposes 66.6. This is a devil level, 66.66 for today. All right. However, an hourly close below 65.80 will invalidate today's intraday bullish bias for that minor counter trend rebound scenario to see further weakness. Retesting 65.80, a breakdown below it exposes the 200-day moving average, I think, as a support as well at 65.40. All right. Now moving on, next will be the dollar yen. So last Friday we flipped to a bullish bias on the dollar yen, continue to hold above 15660 level. So on during the Friday US session, it tumbled but didn't actually break below 15660, which is also the 20-day moving average. So with that, no change. We'll be using 15660 as my short-term pivotal support for today. Still maintain that short-term bullish bias on the dollar yen. A break above first resistance level to watch will be 15-figure level, 15830 level, which is the intraday high on last Friday, above 15830 exposes the long-term pivotal resistance level, which is the lower limit at 15950 next. All right, we'll be over here. Okay, 15950. Only an hourly close below 15660 will invalidate today's intraday bullish bias on the dollar yen to see potential weakness to expose the 50-day moving average that is also acting as a graphical support, confluencing it at 15580 slash 15540 level. Only a breakdown below 15540 exposes the minor swing low of 5th of June at 15460 next. All right, so that's pretty much sum up for the short-term intraday technical outlook for today on the dollar major pair. So now let us now move forward to the major stock indices. All right, starting with the Asia Pacific indices first, with the Japan 225, the Nikkei 225. So the Nikkei 225 continues to be rather mixed at this point in time. All right, so with that over here, yesterday it managed to bounce out from 3790, 3790 level. It bounced out, but for today it can't break above the 50-day moving average, like we see over here as we are speaking. So with that, right, I will flip to a neutrality stance. So technical elements is rather mixed as well. So if you look at this point in time, the hourly RSI continues to be kept by a descending trend line resistance. Okay, with that. So with that, I'll rather have a neutral stance for today. Okay. Okay, neutral between 38,600. That's the upper limit. And the lower limit will be this. Give me a minute. I have to adjust a bit. Okay, this minor swing high broken up turns into a pullback support level right now. Okay, this minor high that was broken out yesterday, all right, during yesterday's push up during yesterday's US session. All right, so neutral today between 38,600 and 38,240 on the Nikkei 225. All right, only an hourly close above 38,600 will kind of validate a short-term intraday bullish bias to expose the next near-term resistance at 38,750, followed by 39,020 next on the Japan 225. But however, if we start to see a hourly close below 38,240, then we will start to see another retest on yesterday's minor swing low at 37,960 next on the Japan 225. Okay, now moving on will be the Hong Kong 33 index or the Hang Seng index over here. So the Hang Seng index also pretty similar, continues to trap within a sideways range configuration. So minor sideways range configuration right now since last Thursday. So this was yesterday's push up during after the release of the mixed China data yesterday. Then thereafter during the entire Asia session and during the US session, it failed to break above the minor swing high or the minor range top configuration that is in place since last Thursday at 18,155 level. So with that, right, I'll rather have a neutrality stance for now for today. So flipping neutral between 18,155 and taking into account of yesterday's minor swing low area here. Okay, at 17,000. Okay, 1 second. Let me put it in a better color. Okay, so neutral between 18,155 and 17,000 780. All right, only an hourly close above 18,155 will kind of validate a short-term intraday bullish bias on the Hong Kong 33. Next resistance level to watch will be at 18,380, which confluence with the 20-day moving average, acting as a resistance as well. And above it, potentially sees 18,730. However, an hourly close below 17,780 exposes further potential weakness on the Hong Kong 33, at least on a short-term intraday basis, to expose the next near-term support area at 17,600, which is the minor swing low of 1st of May. Below it sees the key medium-term pivotal support at 17,170, we also confluence with the 200-day moving average acting as a support level as well. Now, very quickly will be the European stock indices, the German 30 or the German DAX. So the German DAX plummeted on last Friday as expected, hitting the support area at 17,990 slash 17,930 level. Then thereafter it shaped a extreme oversold reading on the hourly RSI, and yesterday it managed to exit for it, working out the extreme oversold region by shaping this rebound scenario. All right, so this rebound scenario right now is coming very close to the first resistance level at 18,240 level. All right, so what we could see over here is that the hourly RSI, even though it hit the extreme oversold level, there is no bullish divergence. What do I mean by this? The hourly RSI continue to shape a lower low. So what I could see over here is that this exit out from the extreme oversold level is more like a counter trend rebound scenario rather than the start of a new trend change. All right, so overall, the short-term downtrend still remains intact for the German 30. So with that, potentially right now is in the mode of doing that retracement. Okay, so if I do the, okay, 1 second, let me expand my chart. Let me do it again. Okay, so right now it's coming very close to the 38% Fibo retracement at 18,240. So this will be the first resistance level to watch for any potential bearish reversal to take place, maximum 18,380. So with that, as long as this minor counter trend rebound didn't surpass 18,380, we will still maintain that short-term bearish bias on the German 30 for another round of potential weakness. All right, first support level to watch will be for sure will be at 17,990 slash 17,930. A breakdown below it exposes the next near-term support at 17,850. However, an hourly close back above 18,380 will see the extension of this counter trend rebound and invalidate today's short-term intraday bearish bias to expose the next near-term resistance level, at 18,520. Above it sees 18,640 slash 18,685. We also confluence with the descending trend line that is still in place since the current all-time high area of 16th of May. All right, so moving on next will be the US stock indices, starting from the US Wall Street 30. So the US Wall Street 30 is one of the underperformer against the S&P 500 and the Nasdaq 100. On last Friday, it plummeted down and hit the short-term support level. So for now, for sure, it's still trading within this very complex short-term range configuration since the low of 30th of May. All right, it could be a triangle. All right, it could be a triangle. This will be the higher low and this will be the similar high. Okay, it could be something like a ascending triangle range configuration as well. But nevertheless, what you could see, why do I say that? Because the retracement on last Friday managed to, okay, let me do the retracement. Managed to stop at a 76.4% retracement. Let me expand this. Okay, it's a bit slower. High. Okay, notice 76.4% retracement. So what do I mean by this? That if I have to draw this. Okay, I'm not sure why is it so slow. Okay, my apologies, a bit cranky today for trading view. Seems to me that I can't draw that trend line for you all to see. Come on. Yeah, this is the trend line. Okay, so it seems to be trading within this kind of ascending triangle range configuration. Minor one that I stress is the hourly chart since the low of 30th of May. So last Friday it hit the lower limit of this potential minor ascending triangle configuration before bouncing up. And right now it's almost coming to the top of that symmetrical triangle range configuration, top of that ascending triangle range configuration at 39,130, and also now it's trying to play around with the 20-day moving average. So this will be the first resistance level to watch at 38,875. As long as it didn't burst above the 39,130 level, I'll be using the 39,130 level as my short-term pivotal support level, still maintaining that bearish bias within this short-term symmetrical triangle, short-term ascending triangle, like I stress, that is still playing out on the US Wall Street 30. All right, it could potentially do another round of mean reversion decline within this minor ascending triangle configuration to retest the lower limit of that ascending triangle range configuration again on a intraday basis. First support level to watch will be at 38,560, followed by this 38,420 / 38,280. So still maintaining that short-term intraday bearish bias for that potential mean reversion within this ongoing minor ascending triangle range configuration that is still playing out for the US Wall Street 30. Only an hourly close above 39,130 will invalidate today's potential mean reversion bearish intraday bias to see a push up to the next near-term resistance at 39,390, followed above it exposes 39,600 next. All right, over here. Okay, so with that, that will be the US Wall Street 30. Moving on to the strongest among all of them will be the Nasdaq 100. So Nasdaq 100 yesterday pierced above the 19,800 short-term pivotal resistance, and there is still show no signs of a bearish exhaustion. Why? Because the hourly RSI is in the overbought level, but there is no bearish divergence as price continues to shape higher high as well. So with that, I got to respect this ongoing positive momentum that is still inherent inside the short-term chart of the Nasdaq 100 based on the hourly chart. So with that, it actually hit the next resistance that we highlight, which is the 19,990, and also the top of this minor ascending channel that is in place since 31st of May. So with that, there could be a chance of a minor pullback as well. For today, first step. Why? Because the hourly RSI also exit the overbought level. So first support level to watch for this potential pullback that could take shape today. In first step, I would say, okay, will be this potentially this level here, okay, at 19,730. All right, as long as this pullback didn't surpass today's short-term pivotal support that will highlight today, we're at 19,610 level. We will flip to a short-term bearish bias on the Nasdaq 100. Next resistance to watch after 19,990 will be the next Fibo cluster level at 2,120 / 2,155, followed by 2,260 next. Only hourly close below 19,610 will invalidate today's short-term bullish bias to potentially kickstart a much more pronounced, deeper minor corrective pullback to expose the next support area at 19,480, followed by this 19,240 next. Right? Okay, so that sums up the short-term intraday technical outlook on the major stock indices. Very quickly, let us now go to the commodities, starting from gold first, XAU/USD. So XAU/USD also trade in a sideways range configuration since a retest on last Friday at 2,300. That's our first support level, and it did manage to break below it. trade up again and come break up above the first resistance at 2003,380, which are our short-term pivotal resistance that we had on last Friday, before inching down lower throughout the entire Asia session to US session yesterday. So with that, it seems to us that in short term, the XAU/USD has starts to be trapped in a minor range configuration. So we will be flipping to a neutrality stance between 2,338 and 2,300. Only an hourly close above 2,338 will kind of validate a minor bullish breakout scenario from this neutrality range. Next resistance level to watch will be at 2,354, followed by 2,386, which is the minor swing high of 7th of June. All right, only an hourly close below 2,300 will see the continuation of this minor corrective decline scenario to play out to expose the medium-term support zone at 2,280/2,270. Now, moving on, next will be the WTI crude oil. So WTI crude oil price yesterday very strong. It managed to have a push up with a strong bullish candle, a positive close at positive 2.4% despite a very mixed number economic data from the China side of the story, and managed to surpass the 200-day moving average and the 50-day moving average as well. So it seems to us that there could be a chance of a major bullish reversal that has been formed over here, this V shape, right at exactly as this major ascending trend line that I drew from 20th of March last year, this level here. So this could be the major bullish reversal. And yesterday's push up in price action has already almost erased off the previous sell off that was induced by the OPEC Plus meeting. All right, so with that, I got to respect the current bullish price action and flip to a short-term bullish bias for today. All right, on the West Texas oil. All right, so for the West Texas oil, yesterday the hourly RSI has hit the overbought level, and now he's already exit from the overbought zone, indicating to us there could be a chance of a minor pullback to the first support zone, this zone over here at 79.45/78.90, which was last Friday short-term pivotal range resistance, now turns into a pullback support level. But as long as this pullback didn't break below the 20-day moving average, now that is acting as a support. So I'll be using the 77.60 as my short-term pivotal support level to flip to a short-term bullish bias on West Texas oil. Next resistance level to watch will be at 81 level. A break above 81 exposes the next near-term resistance at 81.90, which is the minor congestion area of 1st of May and 1st of May. All right. However, an hourly close below 77.60 will invalidate this short-term bullish bias to see another round of choppy corrective decline movement again to expose the next near-term support area at 76.70, followed by 76.30. A breakdown below 76.30 exposes the next support at 75.45. All right, so that's the outlook for the West Texas oil. So before we go, let's take a look at the economic calendar. I want to highlight there are several key economic data to watch out for today, especially related to the Australia dollar, which is the RBA interest rate decision that is out at 12:30 p.m. Singapore time. Market is expecting no change at 4.35%. Why? Because recently the monthly CPI indicator for Australia has going to tick up in April to 3.6%, above 3.5% that was printed in March. Okay, so that could actually allows RBA to maintain its stance at 4.35%, and any hawkish vibes that is being seen in the statement that will be released later could potentially lead to a firmer Aussie dollar. So that's 12:30 p.m. And 1 hour later at 1:30 p.m., the RBA governor will hold a public press conference to discuss about any potential forward guidance on RBA, something to look out for as well. So over the European zone, at the you will see the release of the finalized inflation rate data out at 5 p.m. Singapore time, and as well as a similar time you will start to actually release the ZEW economic sentiment index as well. And going forward, one more important data to watch out for before we go. US session, 8:30 p.m. US retail sales will be released Singapore time, 8:30 p.m. Singapore time. Then thereafter, we do have a slew of Federal Reserve officials speaking. Fed banking will be speaking at 10 p.m. Singapore time later. And right in the Asia early Asia timing, Singapore time, 1 a.m. Fed Kugler and Fed Logan, followed by Fed Musalem and Fed Gospi speaking at 1:30 a.m. and 2 a.m. Singapore time. So with that, that pretty much sum up for today's daily dose of market insights. I wish you all a great day ahead, and this is Kelvin here signing off, and we shall speak again tomorrow. Thank you.